Inspiring interviews with today's top landlords. This is the Rental Income Podcast. And now, Dan Lane.
My guest on the podcast today has been incredibly successful in building out his rental portfolio. He attributes his success to four things he did and continues to do today. And on the show today, I want to walk through those four things and see if we can figure out exactly what he did to get where he is today. First, let's take a real quick break. We'll get a word in from our sponsor, Nevada Real Estate. We'll come back in 30 seconds, and we'll meet Joe Pryor from Oklahoma City.
Are you on track to achieve your financial goals? Income-producing real estate is the most historically proven way to accumulate wealth and has created more financial freedom than any other means. Norada Real Estate provides everything you need to invest in the best turnkey cash flow rental properties. Our simple, proven system will help you create real wealth and passive monthly income. Get your free strategy session with our knowledgeable investment counselors at noradarealestate.com. That's NORADA realestate.com.
Joe, welcome to the podcast. How did you first get interested in owning rental properties?
I inherited this Sunday school of elderly people who, from a realtor that moved out of state, and said, "Can you handle them?" And I said, "Sure." And so I saw these people in their 60s, buying real estate, and I asked myself, that they're doing really, really well. These are the true millionaire next door people because they were all, kind of blue collar. And in the meantime, of course, my wife and I at the time had been doing a lot of fix and flips, and they go, "Hey, this is $10,000 a house. You do 12 of these a year. You make $120,000. And I thought that sounded really good. Mm-hmm. Well, finally, it started adding up. And I went, well, wait a minute. What if I held on to these properties myself? And what would that be? So I started getting education, which is the first thing to do to understand investment, understand what return really means long term. And I said, oh my gosh, if I held on to these properties for 10 or 20 years, then I would be making a whole lot more money. And so that's really what got me going. And actually later than probably I should have, but we all do things when we're ready. And so that's what really got me going in terms of buying long-term rental property.
That's great. And you've been so successful with it. It's just really inspiring to see what you've done with your portfolio. And we were talking before the show, and we kind of narrowed down your success to four different things that you've done. And I want to kind of walk through this and get your thoughts on it. But the first thing that you've done with your approach is you were real conservative in the investments you were picking. Can you tell me about that? Like, what do you mean by that?
Well, first of all, going back to the fix and flips, making $10,000 is really good. But on the other end of the thing, you may lose $10,000. Everybody that does fix and flips I know will lose money occasionally, and I don't like doing that. And so for me, I looked at the risk-reward factor. In other words, anytime you put your money out on something, what's the reward factor and what's the risk factor? So, the thing about real estate is that besides the depreciation of the asset, which allows you to offset taxes, if you do take some losses, they carry forward. You never lose them. And so, once your portfolio builds out strong or strong enough where you are really in a strong cash flow position, then, the losses just are great. You go, okay, I can handle that because there are going to be market cycles. There are going to be downsides. So, the idea of buying a piece of real estate, which is probably easier for most people to understand in terms of what the value is as versus, say, a stock or a mutual fund. It's a one-on-one relationship. It's bricks and mortar. There's appraisals. There's markets. There's everything that you can do to evaluate that. And so for me, when I look at a 16 to 19% return on my money every year, if I hold that for 7 or 10 years, it's very hard for me to find that kind of investment anywhere else that has the same level of risk, especially post-2008, because we're really in a supply and demand market right now.
Sure. Now, to reduce your risk, were you also using bigger down payments?
Well, I have done that more so recently. In fact, when recent purchases that we've made have been more on the order of 40% down. But I'm also in a luxury position in terms of cash. And I'm also at a much older age than probably a lot of your listeners who may be just starting out with their portfolio. But, the thing is that on paper, the lower amount of down payments you make, the better it looks on paper. But at the same time, the more money that you put out for a down payment, the less risk that you have, the more you're protected against the downside. And so my goal was eventually pay these things off, even to the point now where I do 15-year mortgages. But again, I'm not 35 years old.
Right.
I'm about to turn 70. And so our strategies are going to be a little bit different.
Sure.
So 15% down even with mortgage insurance for an investor may be a good idea.
Yeah. Okay. Now, the other thing that you're doing or you've been doing with your portfolio is you don't like to use a 1-year lease. You try to get your tenants on a 2-year lease. How do you incentivize them to want to commit to you long-term like that?
This is probably one of the most important parts of owning investment property. Are you personally really good enough to know what the right kind of renter is? And this is very often why you use a property manager. But the property manager is still going to follow your instructions. So let me give you an example. I have one couple that is in their third year. And we renew those leases every year, by the way. We don't do a 2-year lease on those. But we looked at them and they had a 540 credit score. Now, a lot of people would say, there's no way I'm going to rent to a 540 credit score. But they pay everything in cash and they'd been in their previous apartment for 16 years. Well, there's a lot of character there. There's a lot of trust that you can have. Now, we verify with obviously looking at, besides the credit report, criminal history, things of that nature. But it verifies what we already feel in our gut, that these are going to be long-term renters. And the importance of long-term renters is that, again, when you have somebody present something to you on paper, if we throw in 10 or 20% vacancy rates, your returns go out the door. Mm-hmm. So if somebody is there for 2 years or more and you eliminate that vacancy, your return goes up dramatically. And we've had tenants now up to 10 years. Wow. And so without vacancy. And so we're looking for that type of a person or the type of investment. I think we talked a little bit about duplexes. Mm-hmm. We're getting a lot of apartment type people into duplexes. They're all asking for 2-year leases. And for our investors, for the investors I sell, which is what I do for a living, they're very, very happy with that, obviously.
And so I guess the thing that's really made you super successful is that you have really reduced your vacancy cost and your turnover cost, because that really is the killer of a landlord, those two expenses. So right. the 2-year leases really get rid of that. Now, do you give a discount to incentivize them to sign a 2-year lease?
You just about have to do that. Now, they're going to ask for it. Let's put it that way. And again, if they don't ask for it, you don't do it. But as a rule, they're going to ask for that because they know that, that's signing a 2-year lease is kind of making the term sweeter. And so, for us, here's an example. We, at $1,200 a month, let's say, is what your monthly rental is that you're charging. And a 2-year lease, will you give me a discount for a 2-year lease? Sure, $50 a month. Well, that's $600. All right. 1 month of vacancy is $1,200. Mm-hmm. Right. A discount of $50 a month is $600. And so you just gained $600 of wealth. And so that's the way we look at it. And that's the way you incentivize, someone for a longer term lease.
I love it. I think that's really genius. Now, we have to take a real quick break. We're going to get a word in from our sponsor, and we will come back. And there's 2 other things that you're doing that I want to go into. So hang on. We'll be right back.
Not an offering of securities. Private investments are highly illiquid and risky and are not suitable for all investors. Past performance is not indicative of future results. Securities offered to accredited investors through North Capital Private Securities. Member FINRA SIPC.
I want to thank Realty Shares for sponsoring this episode of the podcast. Realty Shares is a really neat company. Basically, what they're doing is they're out there all day looking at deals, evaluating deals, sifting through them. they're rejecting most of them, but they're taking the very best ones and they make them available on their platform for people to invest in. Before the show, I was logged in and I was taking a look at the investments, and they have a couple of really big apartment buildings that would be just impossible for regular people to invest in. I mean, they're looking to raise millions of dollars, and most people just don't have that kind of money laying around. But the great thing with realty shares is you can invest in those projects, because what they do is they take a little bit of money from hundreds of people, and then we can go in there collectively and invest in these deals. So it's really cool. I mean, you can get started with just $5,000. I mean, that's really not much money to get into some really big deals. So it's really cool. It's totally free if you want to sign up and take a look around and see what they got. You can check out the due diligence for their properties and make sure that this is something that you want to invest in. And I think it's really cool that you can make these investments right from your computer or your phone. They have a special offer just for our listeners. If you go to realtyshares.com/rental, that's REALTY shares, realtyshares.com/rental, you can get $100 towards your first investment. So I think that's really kind of a no-brainer. I would definitely check it out. realtyshares.com/rental. That's REALTY shares.com/rental. All right, let's get back to the show. Joe, so of the four things that have made you successful, number one is that you were very conservative in your approach. Number two, you signed 2-year leases. And the number three thing is you don't invest for appreciation. You only invest for cash flow. Is that right?
That's my philosophy. I'm not going to try to tell everybody to do as Joe does, but here's the reason why. The most predictable statistic or metric that we can use in investment is cash flow. And I've seen over the course of time, I've seen a lot of people lose their short based on appreciation, because that may mean negative cash flow. And on paper, that looks really, really good. But, the thing is, that's not my philosophy. My philosophy is to build long-term wealth. My philosophy is to build up cash. And my philosophy is also to have enough money coming in from positive cash flow that if I just had something happen to me where I couldn't work anymore or I didn't want to work anymore, I could say, okay, fine. I can cover everything that I have. Doesn't mean I don't pay attention to appreciation. For instance, I don't want to buy in a neighborhood where I know that it's static or maybe going downhill. I don't care what the cash flow is. So to me, I look at cash flow as the most realistic 1-year snapshot of what an investment looks like. And then the appreciation becomes a bonus. And that does help build your wealth also. So I'm not so concerned if I see a market that's coming back 10 or 20%, I know the reason why is it was a bubble market. For instance, I bought in Florida for $125,000 less than what the previous buyer bought it for. So if there's a 10% appreciation, it's still way off. So if I'm in a good market that is constant, positive cash flow, low vacancy, then I'm really, really building reasonable, predictable wealth. Mm-hmm. And then the appreciation becomes a bonus.
Now, when you were building out your portfolio, was there a certain dollar amount that you were targeting every month?
And I think that's an important way to look at it. In other words, anybody, if you're 30 years old or 35 years old, fortunate enough to have money that you're putting into your first property, the idea is, where do you want to go? I mean, what is the purpose of this? Are you paying for your son and daughter's college education? Are you saying, I want to retire at 55 years old? And so what you need to do is, I want a retirement calculator or calculation. So I'm going to live 25 years and I just want to enjoy life. And for that, I need $10,000 a month, not counting Social Security or anything else. And so I think it's very important that you set those mental goals and say, and also, when do you want to get there? Mm-hmm. Is it 5 years? Is it 20 years? And so I think doing that really is very, very helpful for you in terms of managing your portfolio. So yes, absolutely.
Okay. Okay. Now, the fourth thing that has made you a success is paying your properties off. Now,
Yes.
Tell me about this. So, what are the advantages to not having a mortgage? Is it just that you reduce the risk if there's a market downturn?
That is one of the big ones. The thing is, excuse me, my voice kind of going there. Markets turn, markets change. We have to understand, just like, it may not be like 2008, which really targeted real estate, but markets go up and down, economies change. And so what happens is, again, thinking about downside risk, which is always, I think, a part of your evaluation, is if I have something that's paid off, and let's go back to that $1,200 a month, and let's say something happens to the Oklahoma City economy and the rental market is going down. Well, I can take $900 a month and be very happy with it. Well, not completely. I'd rather have the $1,200. But if you owe $1,000 or $1,100 a month, you're in real trouble,
right?
At that point. And so, for me, to to get 7 figures of wealth completely paid for takes away from my downside risk. And this is also an asset. You can go to any bank, and if you need $100,000, you can say, here's my portfolio, and they'll say, here's the money. And so you always have that ability. If something happens and you need $100,000 for whatever it happens to be, maybe you're going to Houston for cancer treatment like I did in 2008, and you're going, thank God I have that money. Thank God I have that asset. And so things happen to us. And so protecting against the downside risk is extremely important. So for me, that's the goal. Pay for all of these, have them free and clear.
Now, I think the disconnect that people run into with paying down the properties is when they're building out their portfolio. If they have, say, an extra $20,000, that could be a good down payment to buy another property, or they could pay down the mortgage on an existing property. What do you think is the better move at that point for someone that's maybe just starting out?
That's a great question. And I think the easy answer is take that and buy another property. The thing is, if you own one property and you have a 100% vacancy rate, if that thing is vacant, versus 5 properties where you have a 20% vacancy rate, and the other 4 can make up for the one while it is vacant, then the idea is you need to build up a safe portfolio. If you have one property, you basically probably inherited it, from a family member or something like that. That's not real serious in terms of going into investment property. I don't know of anybody that's successful that has less than 5 properties.
Right.
I think Fannie Mae lets you buy 10, for instance. And so you may have some duplexes or quadruplexes in there, but you have multiple rental properties. And I think that's the point you need to get to. Once you're there, and that goes into that, I need that $10,000 a month, then at that point, you can say, well, I've got a 5% interest rate. And so now it's time. I've got all that I think that I need. And so now if I go ahead and pay down on the mortgage, which is front loaded, of course, as we know, for interest, well, then I'm making 5% on my money, and that's not bad money. And so, that's the point you need to get to, but you need to build your portfolio first. So the $20,000 should go into another property.
Right. Okay. I agree with you. I think that paying down the property is maybe something you should do after you've already built out a comfortable portfolio, but probably shouldn't be a focus early on when you're building out, right?
Right. And then the other thing is if all of a sudden you're looking at your properties and you have, and we know inflation's going to rear up just a little bit, but if you have a 3.25% interest rate, you really have to question why you want to pay that off, too. Because, again, there may be a better way of using your money because we invest in things other than real estate. And so I think highest and best use is the term that you should use. And that may be paying down a mortgage if it's a higher interest rate. I would tell people if you've got a credit card with 16% interest rate, I know where your money ought to go.
Right.
Is to get rid of that.
Yeah. Leverage is definitely your friend in real estate. I mean, you've got to use that. It's such an important and such a powerful tool to build out a portfolio. So, well, Joe, thank you so much for coming on the show. I really appreciate it. Now, you are in Oklahoma City, and you also are a realtor. So if
Yes.
someone is interested in investing in the Oklahoma City market, can you tell us how we could reach out to you and a little bit about your company?
Yes, I would. First of all, let me give you an email address, which is very easy. It's joe@joepryor.com. That's joe@joepryor.com. That can start things, and we can line out a time where we can talk. This is my 27th year of real estate. I do nothing but investment property. That's everything that I do. I don't do regular buyers, don't do listings. All I do is investment real estate. Oklahoma City, our company is based on the fact that it's a combination of low cost of living, affordability in terms of housing, and also population growth. We're the number 9 city or metro area over 1 million in population growth. So we have basic factors that really do support great real estate. In fact, 95% of my clients don't live in the state of Oklahoma. So that kind of tells you that people are looking for markets. Oklahoma City certainly is one of the really good conservative cash flow markets that are out there.
Awesome. Well, I will go ahead. If you missed that, I will put Joe's contact information in the show notes page. You can find that by going to rentalincomepodcast.com/episode 111. Joe, thank you so much for coming on the show. It was great talking to you, and we'll talk to you soon.
I appreciate the invitation. Thank you.